Imagine taking a $1.8 billion hit on your balance sheet, seeing a pretty noticeable spike in your early stage bad loans, and then
listening to your CFO call the entire quarter a massive success.
Right, exactly. I mean, for most companies, those numbers would be a complete disaster. But today on Talk Tickers, we are looking at a bank that is leveraging that exact scenario to completely rewrite the rules of global finance. Welcome to this custom-tailored deep dive.
Yeah, we are focusing on a single, incredibly dense piece of source material today. It's the transcript of the Q1 2026 earnings conference call for New Holdings. And, for anyone operating in the financial sector, or really anyone interested in how tech is reshaping traditional industries, this document is it's a goldmine.
It really is. Now, New Holdings, better known to many of you listening, as Nubank is operating at a scale that is genuinely difficult to comprehend. They're an absolute financial powerhouse in Latin America. And our mission in this deep dive is to look past the dense Wall Street jargon and figure out how they are actually doing it. We always like to keep things actionable here.
Right, data forward, but plain language.
Exactly. We want to hit the headline numbers, understand the story behind them, specifically how they are using AI at their core, and look at their guidance for the future, like their U.S. expansion. And then, we'll give you our bottom line verdict on whether this is a strong signal or not.
It's a fascinating case study because reading through this transcript, you realize you aren't just looking at an accounting presentation. You're looking at a blueprint for how to dismantle a legacy industry.
Okay, let's unpack this. Starting with the headline numbers from this Q1 2026 report, because the sheer scale it's wild. They have officially surpassed 135 million total customers.
Wow.
Right. In Brazil alone, they have over 115 million customers. That makes them the largest private financial institution in the entire country. Mexico just crossed 15 million, putting them in the top 3 there. And Colombia is nearing 5 million.
And we have to emphasize for you listening that these are not inactive vanity accounts. The management team frequently pointed to their earnings generating formula. This is the engine driving their financials. They brought in $5 billion in revenue for the quarter.
$5 billion.
Yeah, $5 billion. And hit a historical high net income of $871 million.
So that formula is what I really want to dig into, because the first 2 parts make intuitive sense, right? You have a massive growing customer base and you have high engagement. The transcript notes their monthly activity rate is holding steady at 83%.
Which is huge for a banking app.
Yeah, people aren't just downloading it, forgetting it. They are using it constantly. The third piece is monetizing that engagement. Their average revenue per active customer, or ARPAC, as they call it, is sitting around $16.
Which brings us to the fourth and arguably most important part of that formula, their low-cost scalable platform. This is where the structural advantage actually lives.
Okay, wait, let me push back on that idea of low cost for a second. Because in almost any other industry, hyperscaling like this is punishingly expensive.
Oh, absolutely.
Right. If a telecom company or a legacy retail bank absorbs millions of users across multiple countries in a single quarter, their costs usually explode. I mean, they have to build physical infrastructure, hire massive customer service teams, spend fortunes on marketing.
Yeah.
How is New Holdings defying that basic law of business physics?
Well, you're looking for the mechanism that breaks that traditional cost curve. And in banking, we measure that mechanism using a metric called the efficiency ratio.
Okay, let's define that for the listeners.
Sure. In simple terms, this ratio measures how much it costs the bank to generate $1 of revenue. So if a bank spends 60 cents to make $1, they have a 60% efficiency ratio. Lower is always better.
Makes sense.
Noon just had a record low efficiency ratio of below 18%.
Wait, so they're only spending about 17 or 18 cents to operate the bank for every $1 they bring in?
Specifically, 17.6% reported. And if you strip out some targeted future investments, their core efficiency ratio was 16.6%.
That's unheard of for a bank of this size.
It really is. And the executives on the call were very clear that this isn't the result of some temporary budget cut. It's a structural reality. They estimate their cost structure is 20 to 30 times more efficient than the legacy incumbent banks that currently control the global market.
You don't become 20 to 30 times more efficient just by, optimizing a few spreadsheets. Something fundamental has to be different about how the business is built. And according to the earnings call, that fundamental difference is their approach to technology. specifically how they are utilizing artificial intelligence.
Yeah, we see a very distinct philosophical divide here. Most legacy banks view AI as just a productivity tool.
Right, like a glorified spell checker.
Exactly. They buy an off-the-shelf software package, bolt it onto their 40-year-old mainframe computer systems, and just hope it makes their loan officers a little bit faster.
It's the classic corporate move. Buy the buzzword, put out a press release, but change absolutely nothing about the core of the business.
New operates from a completely different premise. The CEO explicitly stated they are redesigning how financial products are manufactured from the ground up. I mean, think about their origins. When they launched in 2013, they didn't just take a traditional bank branch and build a digital twin of it.
Right. They built a bank that fundamentally did not require branches at all.
Exactly. And now they are applying that exact same logic to AI. They aren't adding AI to a bank, they are rebuilding the bank around it.
The transcript breaks this technological shift into 3 distinct phases. Phase 1 is AI assistance, which management says is essentially fully deployed. Employees have near 100% utilization of these tools, and the results are concrete. I mean, engineering throughput is up over 50%. And the time it takes to test new software is 90% faster.
That speed really explains how they can maintain such a surprisingly low headcount while scaling at this unprecedented rate.
But, faster coding on the back end doesn't matter much if the customer is still stuck in a clunky, outdated banking app. How does this technology actually reach the person holding the phone?
That leads us to phase 2, workflow reinvention. This is currently in motion. Management described teams taking entire customer journeys, everything from how you open an account to how you dispute a fraudulent charge, and just rebuilding them completely.
Wow.
Yeah, and because the AI tools have made the team so much faster, they are already working on products and features they hadn't originally planned to touch until mid-2027.
It's acting like a time machine for their product roadmap.
It really is.
And then we hit phase 3, which they call the AI native bank. This is where the source material gets incredibly interesting. They are deploying proprietary foundation models, which they call Newformer. They are using these models in production right now for credit card decisions and unsecured personal loans. The AI is performing real-time valuations for personal loan requests. It calculates the net present value, prices the loan, and approves it individually for that specific customer in under 1 second.
Under 1 second.
Yeah. But wait, I have to stop you there because that sounds terrifying. Sub-second loan approvals driven entirely by an algorithm. We've all seen the news stories about AI hallucinating facts, making wildly illogical decisions. If you hand over the keys to the bank vault to an algorithm, aren't you risking a catastrophic failure?
That is a highly rational fear, and honestly, the analysts on the call were probing that exact vulnerability. Management's defense centers on their core operating principle. AI executes, humans hold judgment.
Okay, what does that mean in plain English?
It means the AI isn't setting the overarching risk appetite or deciding the macroeconomic strategy. It is executing incredibly complex math at a speed and scale that humans simply cannot match, but within boundaries set by humans.
But even if humans set the rules, an AI model is only as smart as the information it learns from. If it learns from bad data, it's going to make bad loans.
Which is why their ultimate structural moat is their first-party data. New has 135 million customers transacting inside their ecosystem every single day. That generates one of the largest, cleanest, and most differentiated financial data sets on the planet.
Right.
Traditional banks have data, sure, but it's often trapped in isolated silos. Like the mortgage department doesn't talk to the credit card department, which doesn't talk to the checking accounts. New is cloud native from day one. Their data is fully unified.
So when this Newformer model is deciding whether to approve a loan, it isn't just looking at a generic, 3-digit credit score. It's instantly cross-referencing thousands of micro behaviors unique to that user within the new ecosystem.
Precisely. It is a highly specialized engine running on premium exclusive fuel.
Okay, but even with the best data in the world, if you are approving unsecured personal loans in less than a second, you're going to take on risk. Which pivots us into the most heavily scrutinized section of this earnings call. This is where we get opinionated on the talk tickers side of things.
Actually, yeah, the bear case.
Right, because if people don't pay back their loans, the entire system collapses. And looking at the Q1 numbers, the non-performing loans, or NPLs, are going up.
Yeah, the transcript shows the 15 to 90-day delinquency ratio, which is a leading indicator of early-stage loans going bad, increased by 89 basis points to reach 5%.
And their credit loss allowance, which is the money they have to actively set aside to cover that bad debt, hit almost $1.8 billion. I mean, if I am an investor, an allowance of almost $2 billion looks like a massive red flag.
Yeah.
It feels like the AI might be flying a little too fast and loose.
That tension was palpable during the Q&A portion of the call. But Guilherme Lago, the CFO, offered what I think is a masterclass in financial mechanics to explain why this isn't a crisis. He broke down the $1.8 billion allowance into 3 specific drivers: seasonality, growth, and mix.
Okay, let's translate those mechanics for you, the listener, because understanding this is vital for reading any modern financial report. Let's start with seasonality.
Seasonality is the most straightforward factor. Consumer behavior just follows predictable cycles. People spend aggressively during the holiday season at the end of the year, and then in the first quarter, they tighten their belts and delinquencies naturally tick upward. This happens every single year, and it accounted for a significant portion of that 89 basis point increase.
So normal consumer behavior completely expected. Let's move to the second driver, growth. How does simply growing the business cause a massive immediate allowance for bad debt?
This requires a quick detour into accounting history, specifically a rule called IFRS 9.
Oh boy, accounting rules. Keep it plain language for us.
I will. Look, after the 2008 financial crisis, global regulators realized banks were heading massive amounts of risk. They were only recording losses when a loan actually defaulted. That meant a bank's balance sheet could look incredibly healthy right up until the moment it collapsed under the weight of toxic mortgages.
Okay, so IFRS 9 was designed to force transparency.
Yes. Under IFRS 9, when a bank expands its credit portfolio, meaning it issues a new credit card or increases a loan limit, it is legally required to provision for the lifetime expected losses of that credit upfront on day one.
Let me make sure I have this straight. If New approves a customer for a new $1,000 credit line today, the accounting rules force them to take an immediate hit on their books for the losses they predict might happen over the entire life of that account.
Yeah.
Even if the customer hasn't missed a single payment yet.
That is exactly how it works. Growth inherently creates immediate accounting costs. And because Anu grew their total credit exposure by 44% year over year to over $70 billion, they had to book massive upfront provisions. Portfolio growth alone contributed over $400 million to that allowance increase. The CFO is arguing this is a sign of aggressive scaling, not a sign of the portfolio rotting from the inside.
Wow. Okay, so a large part of that $1.8 billion isn't actual lost money. It's a regulatory buffer required because they're growing so fast.
Yeah.
That brings us to the third driver, mix.
Mix refers to the types of financial products they are prioritizing. They are intentionally leaning into unsecured personal lending and credit cards. By nature, these products have higher expected loss rates than something highly secure, like a mortgage backed by physical real estate. However, they also carry massively higher profit margins.
Right. And this introduces a critical concept the management team highlighted: duration. They stress that their portfolio has a very short duration. Now, I know what that means in theory, but how does short duration act as a defense mechanism for a bank?
Think of a traditional legacy bank like a massive cargo ship. They load up their balance sheet with 30-year fixed-rate mortgages. Once they set a course, it takes miles to turn the ship. If the macroeconomic environment changes, say inflation spikes or the housing market crashes, they're stuck holding those long-term assets for decades. They just can't adapt.
So Nubank is operating a fleet of agile speedboats instead of a cargo ship.
That's a perfect way to visualize it. Because their portfolio is built entirely on credit cards and short-term personal loans, the money turns over rapidly. If their AI models detect consumer stress, or if the broader economy turns sour, they aren't locked into a 30-year trajectory. They can tighten credit limits, adjust pricing, and completely pivot their strategy in a matter of days.
They can steer away from the iceberg long before the cargo ships even see it coming.
Exactly. Which allows them to manage risk at a highly granular level, neutralizing threats before they become systemic issues.
So what does this all mean for you? As an investor considering this stock, you cannot just look at the cost side of the equation, things like rising NPLs or large credit allowances. You have to look at the revenue side and the structural agility of the business. Our opinionated take here is that this is highly calculated. News management stressed. They optimize for resilient NPVs, net present value. They are looking at the total profitability of a customer cohort over time, factoring in those expected losses.
Right. They understand that if you try to minimize bad loans to zero, you also drop your growth and your profits to zero. It is entirely about pricing the risk accurately. And the Q1 data strongly suggests their AI models are pricing that risk with incredible discipline.
Absolutely. So now that we understand how they manage massive scale and tight risk controls, the earnings call shifts focus to the horizon, management's guidance. Because a company that already banks more than half the adult population of Brazil eventually needs new avenues for growth. The analysts uncovered some fascinating hidden blue oceans in the transcript.
Yeah, one data point genuinely surprised many on the call: their progress in the SME sector, small and medium enterprises. The CEO revealed they have quietly built a base of over 5 million SME customers.
The detail that stands out there isn't just the 5 million businesses. It is the cost to acquire them. In traditional banking, acquiring a business customer is notoriously expensive. You have relationship managers, expensive lunches, massive marketing campaigns, and weeks of paperwork. New reported a customer acquisition cost, or CAC, of zero.
Zero.
How do you acquire 5 million businesses for free?
By realizing that your massive consumer base is already full of business owners. A huge percentage of the Brazilian workforce operates small businesses or side hustles. Because Nu already had over 110 million individual consumers actively using their app, they didn't need to run external marketing campaigns.
They just send a push notification. We notice you have a side hustle. Would you like a business account? One tap, and the business is onboarded.
Yep. It leverages the ecosystem they've already built. It's a phenomenal structural advantage that legacy banks with their fragmented systems simply cannot replicate.
The transcript also dismantled a lingering stereotype about digital banks. There is this persistent narrative that fintechs are only for young people or the mass market with very little actual wealth.
The numbers tell a completely different story. Nu currently banks 2 out of every 5 high-income Brazilians. And the purchase volumes within this high-income segment are growing at over 40% year over year. By rolling out premium metal cards, integrated travel portals, and high-end investment products, they're capturing the entire wealth spectrum.
But the true wild card of the Q1 call, and the subject that generated the most polarizing questions from analysts, is their strategy for entering the United States.
Oh, the U.S. is the ultimate proving ground. It is an incredibly saturated, highly competitive market dominated by entrenched legacy giants. When a foreign bank tries to enter the U.S., it usually ends in a multi-billion-dollar bloodbath of wasted marketing spend.
But Nu's approach is fascinating because they are treating the U.S. market not as a guaranteed conquest, but as a financial call option.
Let's explain that. In finance, a call option gives you the right to buy an asset, but your downside risk is strictly limited to the small premium you paid up front. If the bet goes to zero, you only lose that premium. But if the bet pays off, the upside is theoretically infinite.
The CEO applied that exact logic to their U.S. expansion. He explicitly stated they are capping the operational expense headwind for their U.S. investment in 2026 and 2027 to less than 100 basis points on their consolidated efficiency ratio.
To translate that out of finance speak, 100 basis points is just 1%. They are limiting the cost of the U.S. experiment to a 1% drag on their overall efficiency.
Meaning, even if their attempt to enter the U.S. is a complete and utter failure, the financial impact on the core company is tiny. It's a known, bounded, and fully absorbable loss. It will not derail their profitability in Latin America.
But if they do find product market fit, if American consumers respond to the app the way Brazilian consumers did,
then the upside is uncapped. They get to unleash their incredibly low-cost AI-native infrastructure into the largest retail financial services market in the world.
And this creates a fascinating psychological dynamic, which management actually pointed out on the call. Whenever Nu has entered a new market, first Brazil, then Mexico, then Colombia, the local investors are almost always the most skeptical.
It's the curse of the local perspective.
Yeah.
When you grow up surrounded by massive skyscrapers with bank logos on them, it's very hard to imagine those institutions being disrupted by an app. You assume the status quo is invincible, completely missing that the technology running inside those skyscrapers is decades out of date.
Right. The foreign investors who aren't blinded by local nostalgia are usually the ones who recognize the structural math. And as Nu sets its sights on the U.S., you can see that exact same skepticism playing out among American analysts.
Let's pull all of these threads together for our bottom line verdict. This transcript gave us a front row seat to a company operating at mind-bending scale. 135 million customers generating $5 billion in a single quarter. We explored how they maintain a record-breaking efficiency ratio by operating cloud-native infrastructure, completely sidestepping the massive physical costs of legacy banking.
We examined how they are moving beyond superficial AI chatbots, utilizing proprietary Newformer models to manufacture financial products and assess risk in under a second. We unpacked the reality behind their $1.8 billion credit allowance, seeing how IFRS 9 accounting rules and short-duration portfolios turn apparent risks into highly calculated growth strategies.
And we looked at their future guidance, from acquiring millions of small businesses with zero marketing spend to placing a highly disciplined capped call option on the U.S. market. Bottom line, this is a massively bullish signal. The structural advantages here are just too deep to ignore.
The reason a deep dive into this material is so actionable for you is that it trains you to read between the lines. It demonstrates why you should never panic at a scary headline number, like rising NPLs, without understanding the mechanisms underneath. You have to understand things like upfront accounting provisions and structural data moats to truly evaluate a modern business.
It is entirely about looking past the noise to see the machinery, which leaves me with a final thought for you to mull over as we wrap up. We just detailed how an AI-native, hyper-efficient bank from Latin America is preparing to test the U.S. market with a strategy that has virtually no downside risk, but infinite upside potential. If they find even a fraction of the success they found in Brazil, what does that mean for the traditional brick-and-mortar legacy banks in the United States? In a decade, will the global standard for your banking experience be dictated by Wall Street, or will it be determined by algorithms forged in São Paulo? Thank you for joining us on this deep dive into the numbers, and we will catch you next time.